Howdy, Jacob here. Today we're looking at National Beverage Company, ticker symbol FIZZ. So in the beverage industry, 4.75 billion market cap on 4.5 billion enterprise value. It looks like they develop, produce, market, and sell a portfolio of sparkling waters, juices, energy drinks, and carbonated soft drinks. This includes LaCroix, some other flavored water, Rip It, been around since 1985. Currently, the growth for the last at least 5 years hasn't been very substantial, but in the last 10 years, pretty good growth from 641 million to 1.2 billion. And then return on invested capital this entire time has been absolutely astronomical. So the return that they get from reinvesting is substantial, and we see that through their earnings per share going from 46 cents to $1.52. So tripling, over tripling, and their revenue is not even doubled. So that's fantastic. Looks like their shares have remained very flat. It's really just been reinvesting. It looks like balance sheet, 158 million cash on hand with no long-term debt, no short-term debt, 202 million in total liabilities. So beautiful balance sheet, beautiful income statement so far. The cash flow statement, we see that capital expenditures are pretty low. Just 20 million in comparison to triple digit cash from operations. So definitely cash producing mania. Their use of cash is kind of all over the place, at least from what I'm seeing here. It looks like they've paid a dividend in the past. They've bought back a little bit of shares, paid down a little bit of debt. So I'm not really getting much from here. So I'll probably go align with what I want them to do. Which is I absolutely want this company to be reinvesting back in themselves, and with these rates of return and the consistency of the business, it looks like let's start making some assumptions here. So if I do 6% on the revenue growth, I'm going to do an 18p price free cash flow based on their return on invested capital is so great that if they find something to invest in within 2 years, money back. From historical figures at least. And then they've expanded their margins on the operating margin side. So let's look at what an average is and go a little bit higher. Maybe do 16, 14 since free cash flow is a little bit lower. Let's be flat on the share changes, and golly, it just looks pretty expensive. So again, a fantastic company, one that I want to own. I don't think the growth is as astronomical as some of the other ones we've looked at, but I think this company could just become an efficient machine where that operating margin is just closing in on the gross margin. And I think there's still a hefty amount of room to go. Obviously, they're not going to be equal since there's a lot of expenses that go after gross margin to operating margin, but they've definitely improved immensely. Return on invested capital is humongous, where if they find something to invest in, they get a massive return. I don't see them necessarily reinvesting here, but could just be this was just pulled in weird from the 10Ks and such. But for now, yeah, it's just looking a little bit expensive for me. So hopefully you enjoyed the video and have a great day. Thank you.